Understanding Renko Charts, a comprehensive guide. Renko charts, with their unique approach to visualizing price movements, have gained popularity among traders seeking to identify trends while minimizing noise. Developed in Japan, these charts derive their name from the Japanese word for bricks, renga, as they visually resemble a series of stacked bricks. This innovative charting technique emphasizes price action rather than assigning fixed time intervals, creating a distinct method for analyzing market movements. What are Renko charts? A Renko chart consists of a series of bricks that represent price movements. Unlike traditional charts, where a new bar is created at regular time intervals, a Renko brick is formed only when the price moves a specified amount, known as the box size. These bricks are arranged at a 45-degree angle either upwards or downwards, and colored based on the price movement, typically white or green for rising price, up bricks, and black or red for falling prices, down bricks. Key features of Renko charts. 1. Box size. The box size can be customizable, such as 10 cents, 50 cents, or $5, depending on the trader's preference and the asset being traded. It provides a consistent measure for how much the price needs to move to create a new brick. 2. Noise filtering. One of the primary advantages of Renko charts is their ability to filter out minor price fluctuations, thereby allowing traders to focus more on significant trends. Movements smaller than the box size are disregarded, helping to present a clearer picture of market trends. 3. Variable time axis. Although Renko charts do have a time axis, the intervals are not consistent, making them distinct from standard candlestick or bar charts. A new brick might take longer to form in a quiet market compared to a more volatile market where several bricks could form within a short time. 4. Use of closing prices. Renko bricks are generally constructed from closing prices associated with the selected time frame. For example, if the chart is set to a daily time frame, the closing price of each day will dictate brick formation. How Renko charts work. Building a Renko chart. To construct a Renko chart, the first step is to determine the appropriate box size that represents meaningful price movement. Using an example, if a stock is trading at $10 with a box size of 25 cents, then a new brick will be drawn only when the price closes at $10.25 or higher. If the price only reaches $10.24, no new brick is drawn. Furthermore, if the price later falls to $10, a down brick will form below the previous up brick, displaying a downward trend. Trading signals. Traders typically utilize brick color changes to establish trading signals. For instance, if an upward trend is indicated by a series of white/green boxes, a trader might choose to enter a long position when a new white box occurs following a brief pullback evidenced by a red box. Conversely, a change in color from green to red may signal a suitable point for exiting a long position or even initiating a short position. Comparisons: Renko charts versus Heikin Ashi charts. Both Renko charts and Heikin Ashi charts originated in Japan and serve to highlight trends effectively. However, they do so with different methodologies. While Renko charts focus on a set price movement to form bricks, Heikin Ashi charts average the open, high, low, and close prices of the current and previous periods to create candles or boxes of varying sizes. As a result, Heikin Ashi charts can provide insight into potential price reversals with greater detail but may miss some trends that Renko charts successfully illustrate. Limitations of Renko charts. While Renko charts offer clarity by filtering out price noise, they also come with limitations. 1. Lack of detail. Since Renko charts focus purely on closing prices and ignore highs and lows, some crucial price data may be overlooked. A stock that has experienced significant fluctuations may be represented by a single brick, obscuring the broader context of price action. 2. Delayed signals. The reliance on closing prices for brick formation means that significant price moves could occur between bricks, potentially leading to missed opportunities for traders. 3. False signals. Rapid fluctuation in price can create early color changes in bricks, leading to what is referred to as a whipsaw effect. Thus, it is often recommended to use Renko charts alongside other forms of technical analysis for better confirmation of trends. Setting up Renko charts on popular trading platforms. On Thinkorswim. To display Renko charts in Thinkorswim, follow these steps. 1. Open your Thinkorswim account and navigate to the chart settings. 2. Select Time Axis Settings and choose Range for aggregation type. 3. From there, select Renko bars and input your desired box size. On TradingView. Renko charts are also accessible on TradingView, though a paid subscription is necessary. Here's how to set it up. 1. Open TradingView and navigate to the chart menu in the top bar. 2. Scroll down to select Renko. 3. Access the Settings menu to select the desired box size for your Renko chart. Conclusion. Renko charts are a powerful tool for traders seeking to visualize price movements and identify trends without the clutter of minor price fluctuations. By focusing solely on significant price movements, these charts allow for clearer pattern recognition and trend evaluation. However, traders should remain aware of the limitations associated with Renko charts, including potential false signals and a lack of detail. Employing Renko charts in conjunction with other technical analysis tools can enhance trading strategies and provide a more comprehensive view of market conditions.